please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Nifty is 0.5% higher.
DHFL is down 10%.
DHFL, the only thing that happened on Wednesday was one fund house, and I think that's DSP, decided to sell out DHFL. They had no problem. They just wanted to get into cash.
1,600 points down, I think, is what we have on the on the Nifty Junior as well.
For the past 11 years, we've maintained a principle of keeping 20% of our loan book in cash.
There is no default whatsoever, right? The repayments are not even due yet.
The Nifty is back above not only 11,000 but 11,100 as well. I think got a bit overdone.
In our liquid fund, we have all AAA or A plus 100% of our security. We have no problem of liquidity of whatsoever, of any kind.
Today's low is now sacrosanct because you've gone there twice, and today we have had a bit of panic factor. 1 month back we had peak greed. Today you had peak fear and peak panic.
Well, those were the top highlights from the week gone by, and what a week it has been, culminating in what has been nothing short of a very, very dramatic Friday. Hello and welcome to this special, The Fear Factor. I'm Surabhi Upadhyay, and with me is Lata Venkatesh, and we are here to take you through what has been another roller coaster week for the street, ending pretty much at the lows. Good evening, Lata. What a day for the market.
Well, absolutely. There's lots to speak about today and to ask of our experts. But before that, let's take a look at the top headlines. Dalal Street ends a volatile session with sharp cuts despite an 800-point recovery. Sensex ends with a loss of around 300 points. Nifty also closes down around 1%. Huge sell-off seen in banks and non-bank financial stocks.
Fear of redemptions in mutual funds and risk aversion to real estate-based NBFCs leads to a sharp fall in NBFC stocks. DHFL sees an intraday low of 55%, but management says its short-term liabilities are much lower than its short-term assets. Indiabulls Housing echoes the same view.
Bank stocks crack in trade. Nifty Bank sheds more than 2%, dragged by Kotak Mahindra Bank, IDFC Bank. Nifty PSU banks also suffer, losing almost 2%. Punjab National Bank, Union Bank and Bank of Baroda with the top laggards.
Yes Bank shares tanked 29% after the RBI denies an extension to MD and CEO Rana Kapoor. All-round downgrades and target cuts from brokerages impact sentiment as well.
And stocks of indebted companies see a sharp fall. Among them are Adani Power, Reliance Communication, Reliance Infra. These lose about 10%. Among others, Central Bank of India stock also nosedived almost 20%.
Well, it's been quite a week. So, Lata, let's just take a step back and, look at what has caused this kind of a stir. I suppose it started with the macros, and then we had issues around ILNFS, and finally, the kind of sort of selling we saw on Friday. I mean, how do you put all of this together?
Well, my sense was actually this week started off with the same macros that troubled us last week. That is a strong dollar, strong crude, and a general suspicion of all emerging market currencies and equities. That continued for a couple of days. But the Indian government's efforts to talk up the rupee started succeeding. And on Wednesday, we saw a genuine return of strength. It was aided by the fact that crude moved off a little bit, and it should have gone on to create a decent rally today, which we did see on Wall Street and in Asian markets. Because the dollar index from 95 plus, actually 95.5 at its peak, has fallen to below 94. So the stage was set for a fairly decent day in equities when suddenly the domestic worries started snowballing. These worries were there already. ILNFS, a very big NBFC, has defaulted on a commercial paper in August, and then on one of its intercorporate deposits in September. It saw a very sharp downgrade, but nobody was prepared for such a strong contagion. The contagion seemed to have spread when DSP Merrill Lynch sold a small quantity, actually just about 200-300 crores of DHFL. but it had to be done at a higher yield and a lower price because possibly there were not so many takers for any NBFC after the IL&FS downgrade. That, maybe that snowballed, but I think much is being made of the DSP sale itself. Clearly, the market is worrying about NBFCs in general because the cost of one-year money is going up for them, and there's a fear that not all of them will be able to roll over their money. Those that roll over will do it at a higher cost, and that's why you saw a rather steep fall in financials in NBFC companies. I just want to put one more point on the table. The market during 2017 actually absorbed a lot of risky paper, both in the debt side and in the equity side. Now people are beginning to wonder whether at a heightened cost of capital, some of these stocks should be shed. But if everybody goes to the exit door at the same time, then clearly there is going to be a fall in prices.
Absolutely, Lata. And yes, people were simultaneously rushing to the exit door on DHFL on Friday, and therefore we saw a 50% decline in the stock, 50% fall coming through. Let me quickly just run through the way some of these factors played out in stock prices, what Lata just described. So risk aversion was the name of the game, and financials is the one space that was really battered down during the course of this week. Overall, for the week to date, the market, the Nifty is down about 3.2%. There's, of course, far bigger selling in the mid-cap market. The mid-cap index is down about 5%. Nifty Junior is down about 4.5%. And if we just go by some of the stocks, some examples, Indiabulls Housing Finance, 13% for the week. Big stocks have been falling within financials, even marquee names like a Bajaj Financials, and that's where some sort of unease seems to be coming in. Bajaj Financial for the week is down 11%. Since its top, it's down 18-19%. I'll also add Yes Bank to the list of headlines. As we just told you, a 30% cut is what we got on Friday once the news came through that Mr. Rana Kapoor is only now going to stay on for a couple of more months, and there were really no buyers inside. SBI, these were some of the other names, Bajaj Finserv. So financials as a space was very weak. I'll quickly move to some of the consumer plays, because the other problem with the market was that stocks like Lever, consumer plays like Maruti, they've also been falling quite a bit, and that continued today as well, even something like a Godrej Consumer. So on Friday particularly, these trends were quite apparent. If I talk about the mid-cap space, then along with DHFL and some of the other NBFCs, of course, the listed IL&FS twins have been battered quite a bit. So IL&FS investment, for instance, is down about 25% for the week. Some of the ADAG group stocks have been extremely weak in trade as well, the likes of HCC, then other names on the infra and power side like Adani. So this is where the weakness was. Having said this, gainers, what worked this week? There was some flight to safety perhaps coming in, some valuation plays catching up on some of the OMC companies. So some of them were slightly higher, and Oil India was slightly up as well. But all in all, very few cherry pickers out there, I guess, Lata. It was really a week that was more about risk aversion and trying to sell down and take some profit wherever you perhaps had it.
Okay. Well, I'm sure that so many of the funds are sitting on lots of profit. I think we're still now back, to July levels or something. I mean, we're not really paired off too much. We rose a lot in August. We tend to forget that. Joining us to discuss this week's action is Marcellus Investment Managers' Saurabh Mukherjea. We will also be joined by Ashwani Gujral, our technical expert, and Nilesh Shah of Kotak Mahindra AMC. Gentlemen, thank you very much for joining me. Well, first, Ashwani, what is your sense about Nifty and Bank Nifty? Have they broken some key support levels, and therefore is there more to come?
See, that is what I want to talk about today, that what is the difference between all the previous 5 to 8% correction and this one. I think the paradigm is shifting from a low rate, strong rupee kind of environment with fiscal control, etc. That was a different environment since demonetization. Now that you have everything reversing, the correction may be only halfway through, because all your problems are basically because of rupee or crude or the rates going up. So what is 8 times book, if it comes down to 6 times, it is still not cheap given the change paradigm. So my sense is that we could go even lower once crude crosses 80, rupee gets back to 73, and all of these little accidents keep happening. The confidence of the market will be lost. Had it been, same paradigm, just a simple correction, chances are we would be closer to the end. But given this situation, you can have a bounce back. For last many days, we can't get a decent bounce back, forget about a rally. So that just shows that even at lower levels, people are willing to sell.
Okay, all right, Ashwani, just stay on with us. Let's also bring in Nilesh Shah of Kotak Mutual Fund into the conversation. Nilesh, thanks so much for joining in. Is it perhaps fair to say that today it was the debt market that actually caused this big equity drop?
Yes, undoubtedly. The straight trade in debt market, which happened for liquidity reason, ended up impacting the entire housing finance sector in equity market and also overall indices.
Okay. Well, Saurabh, your sense, I mean, how do you explain this fall? Is the scare about NBFCs overstated, or is it understandable, justified?
So I lived through a very similar set of experiences through all of 2007 and most of 2008 in the UK. So very vivid memories of very similar discussions in the UK in 2007 and 2008. And I think, I've been saying this for a long time on your channel, we are entering that phase in our country as well, where rates are going up, the currency is under pressure, liquidity is tightening. I think that's the broad backdrop. I'm not underplaying the Divan paper being sold by DSP at 11%, but I'm not so sure how much importance we should attach to that. Clearly, liquidity tightening, potential RBI intervention in October to hike rates, I think is the bigger challenge. Financials, 40% in the Nifty, I've been saying for 6-7 months, makes no sense at all. And I think that's perhaps my request to your viewers be to focus on that. People are holding NBFCs, HFCs, private bank stocks at 4, 5, 6, 7, 8 times price to book. There's no earthly rationale for that. And if because of these specifics or jolts, because of ILFS and Divan, if people sort of come to their senses, so much the better. But I think the weightage of financials in the Nifty, especially wholesale funded financials, is worrisome. Correction was long overdue. Perhaps this freeze in the money market now triggers ultimately that correction that was long overdue.
So, Saurabh, then hearing what you're saying, the sense that I get is you are definitely not a buyer. Even though Bajaj Finance might be down 17%, or even though India Bulls might have fallen as much as it did today, I don't think you're a buyer. I mean, so what lies ahead for these stocks?
No, so I think there's two ways to think about situations like this. One is, if you're someone who has money in the market and it's professionally you're a fund manager and you need to have money in the market, clearly you can't just wholesale abandon your portfolio and run away, and hence a tilt towards IT, pharma, FMCG, the export-centric elements of auto manufacturing. That should be on the cards. You should be going through that. But if you're not someone who perforce has to invest, you have a choice whether you put your money safely away. There is no logical reason to be deploying money heavily in the Indian market at these sorts of valuations, and certainly not in the financial services stocks you mentioned. These valuations make no earthly sense at all. There's no rational justification for attaching such heavy price to books to wholesale market lenders who borrow in the wholesale market 3 months, 6 months, 12 month money, and they simply lend it out 3-year and 20-year in the case of housing finance companies. You're basically attaching 5 times, 6 times price to book to maturity transformation plays. Nobody in their right mind should be doing that.
Okay, see, it is one thing to talk about valuations and quite another to fear that they will not even be able to roll over their liabilities. That's what the market seems to be fearing at this point in time. I'll come to you in a minute, Saurabh. Let's hear the guys themselves. Earlier today, we spoke with DHFL and the India Bulls Housing Finance Managements, and also to DSP Mutual Fund, the one that sold, in their own words, just 200 to 300 crores of DHFL funds, and not even for any pressing reason. Let's just listen to them, and I'm coming back to you, Saurabh.
This has come as a big surprise and a shock to me, that someone who is sitting on strong liquidity position over the last, and it's not just been recent. We are extremely conservative in maintenance of liquidity. There is no default whatsoever, right? The repayments are not even due yet, right? And there is ample liquidity lying with us in our system to take care of interest as well as the principal payouts over the next, couple of quarters.
For the past 11 years, we've maintained a principle of keeping 20% of our loan book in cash. As we speak, we have over 21,000 crores in cash, of which about 65% is kept with mutual funds. So for, mutual funds do provide us with short-term liquidity, but they're also extremely aware that, over 16,000 crores of cash is kept with the same mutual funds.
Entire newsroom and a lot of WhatsApp groups active with this, that DSP-MF has sold quite a bit of paper of DHFL to meet liquidity. Can you confirm or deny that?
It happened that way. It is not much amount. It's just 200 or 300 crores has been sold.
Yes, 300 crores.
About
300 crores on Wednesday, Mr. Kothari, and 70 crores today. I just want confirmation on those numbers.
70 crores you have gone crazy. It is not correct statement. And we have not talked about more than 200-300 crores. That is all the total figure has been sold.
Okay. Well, I want to come to both Saurabh and Nilesh on this issue. Nilesh, is it fair to say that some NBFCs won't be able to roll over their CPs or deposits?
This needs to be viewed in the overall context. One, we had a public financial institution, ILFS, which moved from AAA to D in a very short period of time. The market, rightly or wrongly, had always priced that government will stand behind ILFS or the marquee shareholders of ILFS will stand behind it. It was a company which was real. It is a company which is real. Yes, it has liquidity issue, but there are no credit issue. And suddenly that AAA becoming D created one set of panic for the market. Then we also saw in one of the bank, the MD not getting extension, but no reasons were given for why he is not getting an extension. Then we had a scenario where, when we are managing open-ended funds, obviously one has to take a view based on duration, asset liability match, and so on and so forth. And then there was a straight trade at a slightly higher yield. Now we must understand that in NBFC or financial services sector, if you have to repay maturing obligations and you don't get any refinance, no company can survive because all of them are leveraged between 5 to 10 times. So it is the combination of ILFS and Yes Bank coming together along with this debt trade which has impacted this whole market, and clearly these things can stabilize as quickly as they have started.
Okay, actually I'm going to come back to you with another fun question, Nilesh, but I want to get Saurabh in on this sector, NBFCs. I take your point about valuations, but today the market was afraid that they won't be able to roll over.
So, Lata, I think that if you just dwell for a minute on the markets, why is the market afraid? I don't dispute the fact that that liquidity could come back and things could normalize in the system. But the reason the market worries about these sorts of entities, NBFCs, HFCs, is because every 3-4 months they need a shot of liquidity from the wholesale market. So even if for a 3-4 month window a large NBFC or HFC is not able to roll over its funding and get a fresh tranche of CPs or NCDs going, that's pretty much curtains for that business. So this business model is incredibly fragile. It's always been, whether it's in India, the UK or US, you're borrowing short term, you're lending long term, and you're gearing up 9:1, 10:1, right? So it's a very fragile business model, which is why rational investors buy NBFCs and HFCs at sensible valuations, not the stratospheric valuations that our stock market has given them. So yes, there's potential, there's fear in the market around liquidity. I think the RBI should and can address those fears by stepping in to say that they will backstop the ILFS NCDs and CPs. I think that intervention has to happen. Either LIC or Government of India or RBI has to backstop the ILFS paper. It's just simply too much paper, 90,000 crores of debt, potentially 25,000 crores of NCDs, 5,000 crores of CPs. It's a lot of paper there. Somebody has to backstop that. But even if after that's backstopped, you still have the small matter of fragile business models being overvalued by the stock market for a good 30-40% of the market cap of the Nifty. So two different issues. The liquidity one can and I think should be addressed by the regulator next week. But the valuation issue is up to everybody who's watching this program to make a rational call on that.
Okay, I guess rationalization becomes really difficult in times of extreme greed and extreme fear. That's the market. All right, gentlemen, stay on with us. We have to take a very quick break, but we will be back and this conversation continues in just a bit.
Welcome back to Taking Stock. It was a week when the markets dropped a goodish bit, about 5.3% as far as the Nifty Bank was concerned, and a similar percentage for mid-caps. The Nifty itself probably escaped with slightly, smaller injuries, but not been a good week, really. For the banking system, one part of the financials got impacted because of this liquidity fear. The other part was Yes Bank. Clearly the biggest casualty. It tanked 29% after the RBI denied an extension to MD and CEO Rana Kapoor. There were all-round downgrades with people bringing down the price of the stock from 440 to 230 to 270. That was the kind of average I was getting. But the stock has actually ended even below the lowest price that we got from about half a dozen brokerages that went with downgrades or with retaining their neutral and buy call. Let's just listen in to what Krishna Kumar Karwa of MK Global told us earlier today about Yes Bank, and we are back.
It's a large institution which has got created over a period of time, and this kind of knee-jerk reaction by investors of a 25-30% cut, I think valuations look very attractive. I'm sure there will be another able gentleman who will come and run the show. So from a long-term point of view, I think it's an opportune time for investors to be looking to invest in the bank.
All right, that was Yes Bank, the other piece of the puzzle today. Your thoughts on, a stock like Yes Bank and the entire story here, Saurabh, how would you look at it? Are these good levels to get in, or do you think there is still some information that we perhaps don't know, the market doesn't know?
I mean, look, it's a bank where the promoter and the bank are almost synonymous. Rana Kapoor's been a giant of the banking sector. He's a larger-than-life figure, and almost all of us, when we think of Yes Bank, think Rana Kapoor. So I think there's a long way to go before I can give Yes Bank shareholders any assurance, for what it's worth, that Yes Bank shares are worth buying with the promoter on his way out. This is not HDFC Bank we're talking about, where systems and processes and the whole CASA franchise is a sort of well-established thing. This is a very different institution, very different type of promoter. So I think there's a lot of work they'll have to do to convince the market and build a new identity for themselves almost. In a way, the least of their concern should be, whereas the share price has got far bigger things to worry about.
All right, Saurabh, we'll leave it at that, not the least because we're out of time, but we are not out of questions, and we hope to have you soon to advise investors on where they can put their money. I want to keep Nilesh only for one question. Nilesh, NBFCs apart, mutual funds had this Credit Opportunities Fund, which was floated during the heydays of the mid-caps and the NBFCs. SEBI forced the funds to call it Credit Risk Fund. Now, these are all, this fund has paper which has very high yield and therefore high risk as well. It's an AUM of 90,000 crore. Can these funds see more redemptions?
I don't think so. It is a source of problem. One, SEBI has legitimately and rightfully branded this funds as credit risk fund rather than credit opportunity fund. So investors know that there is a risk. Second thing, let's look at India Bulls case per se. If I remember correctly, mutual funds exposure to India Bulls is about 30,000 crore. And their own investments in mutual fund is about 15,500 crore. If I take into account the undrawn credit line from the banking system and other liquidity in their balance sheet, that's 21,000 crore. So effectively, they are very well in terms of liquidity. And if there is no panic, then obviously there will be stable business. There will be no uncertainty. And if I hear in the market, they have already put a bid for buying back their own paper at a higher yield. So they themselves are capable of providing liquidity on their instruments at above market yields.
All right. Well, that's encouraging to hear. Nilesh, Shah, Saurabh and Ashwani, we're completely out of time. But thank you very much for joining us and making sense of what was a jittery week for the Bulls and a triumphant week for the Bears. Thank you very much from me and Surabhi and the entire Taking Stock team for joining us. Have a great weekend.